If you woke up this morning, Saturday, February 7th, 2026, and casually opened your trading app or checked your metals portfolio, you probably noticed something that didn't quite fit the usual pattern. Silver suddenly pushing higher, gold quietly climbing again, not exploding, but clearly moving. And if you're like most retail investors, your first reaction was probably something like, okay, small weekend rally, maybe geopolitical tension, maybe another rumor about the federal. But what's happening right now is not a normal price move, not even close. What you're seeing unfold in real time is not a routine market fluctuation. It's not retail momentum. It's not speculation. This is a regulatory shockwave moving through the global banking system. And unless you work inside a major financial institution, chances are you had no idea this storm was coming. Because right now, behind the scenes, something massive is happening. Something most traders only realized within the last 48 hours. And the deadline driving all of this? Monday morning, February 9th, 2026. Market open. Let me be very clear. In less than 36 hours, one of the biggest rule changes in modern banking history officially goes into full enforcement across major US and European banks. For more than a decade, regulators debated, delayed, softened, and postponed this rule. Lobbying groups fought it. Banks pushed back. Deadlines were moved again and again. But now, the grace period is over, and global regulators are saying compliance is no longer optional. Banks either meet the new balance sheet requirements or risk losing access to the financial system itself. And the rule at the center of this storm is something most investors have never even heard of: the net stable funding ratio requirement under Basel III. Now you might be thinking, wait, Basel III? Haven't we heard about that for years? Yes, but here's the part nobody paid attention to until now. The enforcement rules surrounding precious metals positions, especially paper metals, have just fundamentally changed. And that is where this whole situation begins. Under the old system, Basel II and the transitional Basel III phase, banks could treat unallocated precious metals positions as relatively low risk. That includes paper gold and silver claims, futures contracts, unallocated bullion accounts. ETFs that don't hold enough physical metal banks could run massive short positions, create synthetic supply through futures markets, and still keep capital requirements low. In simple terms, they could create paper silver and paper gold almost endlessly without needing much real backing. And that system has dominated precious metals pricing for nearly 2 decades. But starting Monday morning, the classification changes. Unallocated precious metals are now considered high risk, the liquid assets under the net stable funding ratio calculation, which means banks must now hold enormous cash reserves against those positions. Let me simplify that. If a bank holds $1 billion worth of paper silver exposure, regulators now require them to hold roughly $850 million in stable capital reserves to support that position. Compare that with physical, allocated gold or silver, which is considered a top-tier asset and requires virtually no additional reserves. In other words, the regulatory incentives just flipped upside down, overnight. And now banks across Europe and the United States are looking at their books realizing something uncomfortable. They don't comply. Not even close. For years, many major institutions profited from shorting precious metals through derivatives and unallocated contracts. They assumed they could always roll positions forward and never actually deliver metal. But now regulators are saying, back those positions with real capital, or unwind them. And failure isn't punished with fines this time. Failure means losing banking privileges, losing access to liquidity support, losing ability to operate in global markets. So what option do they have? They need to reduce exposure, close short positions, or acquire physical metal. And they need to do it immediately, before markets fully open Monday. Now here's where the math becomes uncomfortable. As of Friday's market close, open interest in COMEX silver futures represented over 2 billion ounces of silver. But total registered silver available for delivery in exchange vaults? Only a fraction of that, meaning dozens of paper claims exist for every ounce of physical metal ready for delivery. And regulators are now effectively telling banks, back those claims with capital or real metal. The problem? There simply isn't enough physical silver available to satisfy everyone simultaneously. This isn't just a price rally. This is a structural pressure building underneath the entire pricing mechanism. And that pressure is only just beginning to surface. Before we go deeper into what this means for prices next week, understand something important. What you saw Friday afternoon, that sudden spike, was likely the first wave of institutions adjusting positions ahead of enforcement. And if that adjustment accelerates Sunday night when futures markets reopen, price movement could become extremely volatile very quickly. Because when large players rush to reduce exposure in markets where real supply is limited, prices move fast, sometimes violently. And most retail investors only realize what happened after the move is already underway. And that brings us to the critical question: what exactly are banks facing right now behind closed doors? Because this weekend, emergency meetings are happening inside major financial institutions around the world. Risk managers, treasury desks, compliance teams, all working through one problem. How do we become compliant before markets fully open Monday? And the options available to them are limited, and none of them are painless. And here's the uncomfortable reality those banks are confronting right now. No matter which path they choose, the outcome puts upward pressure on metals prices. Because every available solution forces them to either reduce synthetic supply or compete for real metal in a market where real metal is already scarce. Let's walk through their options one by one. Option 1. Buy back short positions in the futures market. On paper, this sounds simple. Close contracts, reduce exposure, become compliant. But here's the problem. When massive institutions try to exit short positions simultaneously, they become buyers in the same market at the same time. And if there aren't enough sellers, prices don't drift upward. They jump, because markets move based on liquidity, not fairness. If too many players try to squeeze through the same exit door at once, price gaps appear, offers vanish, algorithms chase momentum, and suddenly a controlled adjustment turns into a price spike. That's exactly what started late Friday afternoon. Option 2. Take delivery of physical metal instead of closing contracts. In theory, banks could simply convert paper exposure into physical holdings, which regulators now treat far more favorably. But this is where reality collides with theory. The amount of silver and gold actually available for delivery is tiny compared to outstanding paper claims. Exchange vault inventories look large in isolation, but they're microscopic compared to total contracts trading on paper. So if multiple banks demand delivery simultaneously, inventories drain rapidly. And once deliverable supplies tighten, premiums explode. Because physical sellers realize supply is scarce, and they demand higher prices. Option 3. Raise massive amounts of new capital to satisfy regulatory reserve requirements. But that's not easy either. Raising capital means selling assets, issuing bonds, or borrowing funds at a time when financial markets are already strained. Selling assets pushes other markets lower. Borrowing becomes expensive, and going to central banks for emergency liquidity signals weakness. And weakness invites market scrutiny, which is exactly what banks try to avoid. So banks are stuck in what traders call a no-win scenario. Close positions? Prices rise. Buy physical metal? Prices rise. Raise capital? Markets panic. No option keeps prices stable. Every path creates upward pressure. And that's why what we're seeing now isn't random volatility. It's structural. And here's the part most retail investors still don't fully grasp. This situation didn't appear overnight. The groundwork for this moment was laid years ago, because regulators and central banks have quietly been preparing for a world where paper leverage cannot continue indefinitely. Let's rewind for context. Back in 2019, regulators quietly upgraded physical gold status inside the banking system. Allocated physical gold was reclassified as a top-tier asset, essentially treated like cash reserves. That was a massive signal. But almost nobody outside professional finance noticed. Yet central banks noticed. And what happened next? They started buying gold aggressively. Year after year, official reserves increased. Countries that rarely spoke about gold suddenly became steady buyers. Because physical assets cannot be printed, diluted, or digitally manufactured. They sit outside the debt system. And regulators knew future banking stability would depend on assets like that. Now fast forward to today. Central banks are holding more physical metal. Meanwhile, commercial banks are still heavily exposed to paper markets. So when enforcement hits, institutions holding real assets are comfortable. Those relying on leverage are scrambling. And scrambling institutions create market volatility. Now let's zoom out even further, because this isn't just about metals. This connects to broader stress across the financial system. Think back to recent years. The repo market disruptions, liquidity events, regional bank failures, emergency interventions. Each episode showed cracks forming beneath the surface. Debt levels climbed. Bond markets became unstable. Commercial real estate valuations started sliding. And regulators began asking a simple question: what happens if confidence suddenly breaks? Their solution? Force institutions to hold stronger balance sheets backed by real assets. And precious metals, especially allocated physical holdings, suddenly fit that requirement. Meanwhile, outside the Western banking world, another trend has been accelerating. Countries like China, India, and several emerging economies have steadily increased their precious metals reserves. Not loudly, not publicly, but steadily, because metals serve dual purposes. They are monetary assets, and they are industrial necessities. Silver, in particular, plays a critical role in electronics, renewable energy, defense systems, and advanced manufacturing. So accumulating supply at suppressed prices makes strategic sense, especially if future demand rises while supply struggles to keep up. Which brings us back to right now. Saturday night. Markets closed. But inside bank boardrooms, nobody is relaxing. Teams are calculating exposure, rebalancing positions, negotiating emergency funding lines, trying to get ahead of Monday's enforcement clock. And every hour that passes shrinks their flexibility. Because when futures markets reopen Sunday evening, adjustments begin again. And adjustments at institutional scale move markets, sometimes dramatically. Now here's the timeline traders are watching. Sunday, evening futures open. Initial price reaction appears as institutions reposition. By Monday morning, European markets react. Then New York opens. And if pressure builds across all regions simultaneously, price moves can cascade. Retail investors often wake up after those moves already happen, which is why understanding the setup matters more than reacting afterward. And here's the real wildcard scenario. If even one major institution fails to meet delivery obligations or liquidity requirements, exchanges could invoke force majeure provisions, meaning contracts settle in cash instead of physical delivery. And once confidence in paper settlement breaks, market participants rush toward physical assets, which pushes premiums even higher and widens the gap between spot price and real-world purchasing price. That disconnect has appeared before during crises, but never under conditions this large. So the next question becomes, how do markets behave when paper supply contracts collide with limited physical availability? History gives us clues. But before diving into past examples, we need to understand how price suppression mechanisms have operated up until now. Because the system banks relied on to control volatility may no longer function once capital rules tighten. And that is where the next piece of this story begins. That to understand what could happen next, you have to understand how metals prices have actually been controlled over the last decade and a half. Because most people assume prices simply reflect supply and demand. But in modern financial markets, price discovery often happens in paper markets, not physical ones. And paper markets can behave very differently. Here's how price suppression has typically worked. During normal trading hours, especially in New York sessions, you'll sometimes see sudden, sharp drops in metals prices. No news, no economic data, no geopolitical event, just sudden selling pressure. And the usual explanation given is routine volatility or stop-loss cascades. But professionals know what often sits behind those moves. Large trading desks deploy high-frequency algorithms capable of flooding order books with sell orders, creating the appearance of overwhelming supply. Prices drop quickly, stops get triggered, momentum traders pile in, and then, once price falls far enough, many of those sell orders disappear. The market stabilizes lower, positions get reset, and price suppression succeeds. It's a tactic regulators have tried to limit, but enforcement historically lagged behind technological capability. And banks continued using aggressive strategies because penalties were tiny compared to profits. But here's the catch. This entire mechanism depends on one critical advantage: the ability to create nearly unlimited synthetic supply using futures and unallocated accounts. Once regulations force banks to hold substantial reserves against those positions, opening large new shorts becomes expensive, which means artificial supply creation becomes constrained. And once synthetic supply slows, real supply and demand matter again. And when demand exceeds available supply, prices rise, sometimes rapidly. We've seen versions of this before. Let's step back in time. In 2008, during the global financial crisis, metals markets experienced a strange phenomenon. On paper, silver prices crashed alongside stocks. But try walking into a dealer to buy coins or bars at that time. Inventory vanished. Premiums exploded. While futures markets quoted silver near $9 an ounce, physical buyers were paying nearly double. Supply chains broke. Mints ran out of blanks. Dealers couldn't restock for months. Paper price and physical reality disconnected completely. Then came 2011. Silver surged from under $20 to nearly $50 in a matter of months. Many people labeled it a speculative bubble. But behind the scenes, several forces converged. Investment demand surged. Exchange inventories tightened. And new exchange-traded products increased exposure to physical supply. Eventually, exchanges raised margin requirements multiple times in quick succession. Speculators were forced out. Prices crashed. And markets stabilized again. But here's the critical difference between then and now. Back then, exchanges and banks could change rules mid-game. They had regulatory flexibility. Today, regulators are enforcing stricter balance sheet requirements instead, meaning banks don't have the same freedom to flood markets with synthetic supply to force prices down. Their maneuvering room is smaller. And this situation isn't isolated to Western markets either. Globally, strategic competition for physical resources has intensified. China, for example, has spent years increasing imports of precious and industrial metals. Not loudly, not dramatically, but consistently, because silver isn't just an investment metal. It's essential for solar panels, electronics, electric vehicles, advanced military systems, and next-generation infrastructure. Control supply chains, and you gain strategic leverage. And several nations appear to understand that future economic power may depend as much on material resources as financial ones. At the same time, confidence in traditional debt-based systems has been slowly eroding. National debt levels continue rising. Central bank balance sheets remain bloated after years of intervention. Bond markets occasionally show signs of stress. And investors worldwide increasingly ask the same question: what assets retain value if confidence in currencies weakens? Historically, precious metals answer that question, not because they generate cash flow, but because they cannot be printed. Their supply grows slowly, and they sit outside digital financial systems. Now, let's bring everything back to the present moment. It's still the weekend. Markets are closed, but banks aren't resting. Risk teams are modeling scenarios. Compliance officers are reviewing exposures. Executives are deciding how much risk they're willing to absorb before Monday's enforcement window hits. And the futures market reopens Sunday evening, which means repositioning resumes almost immediately. And repositioning at this scale creates volatility. So what could the next few days look like? Here's a realistic sequence. Sunday night, futures markets open with strong buying pressure as institutions begin reducing exposure. Overnight, European markets react, adding momentum. Monday morning, U.S. markets open into already elevated prices, forcing additional short covering. Then momentum traders, hedge funds, and retail investors pile in once they realize something bigger is happening. And price acceleration feeds on itself. But there's still uncertainty. Because if liquidity dries up too quickly or delivery obligations can't be met, exchanges could intervene. Contracts might settle in cash rather than metal. And once confidence in physical delivery weakens, market participants rush to secure actual metal rather than paper exposure, which pushes physical premiums higher still, and widens the gap between futures price and real-world purchase price. At this point, some viewers are probably thinking, this sounds extreme. Markets always stabilize. And usually they do. But stabilization often comes after sharp repricing events. Look back. Repo market disruptions in 2019. Treasury market instability in 2020. Regional bank failures in 2023. Each event revealed fragility beneath the surface, and regulators responded each time with emergency measures. Now, however, regulators are tightening rules rather than loosening them, which means stress has to be absorbed somewhere. And metals markets may be where part of that stress surfaces first. So the real question becomes, how should individuals interpret this moment? Not panic, Not blindly chase price spikes, but understand what's happening. Because decisions made during calm periods differ from decisions made during market chaos. And once volatility erupts, options shrink quickly, which leads to the final piece of this puzzle. Because beyond price spikes, beyond regulatory enforcement, something bigger may be unfolding. A potential shift in how financial systems measure and store value. And whether that transition happens smoothly or through market shock depends on what happens next. And that is exactly what we need to break down. So now we arrive at the bigger picture. Because what we're watching unfold is not simply about silver prices or gold rallies over a few days. It's about the long-term structure of the financial system itself. For decades, global finance has operated on leverage and debt expansion. Paper assets multiplied faster than real assets. Derivatives grew larger than the underlying markets they were built upon. Synthetic supply often replaced real supply. And as long as confidence held, the system functioned. But every system reaches a point where reality pushes back. Debt grows faster than income. Liquidity becomes harder to maintain. Markets become fragile. And regulators eventually step in to force discipline back into the system. That is what this Basel III enforcement represents. Not a sudden event, but the culmination of years of gradual regulatory tightening aimed at reducing systemic risk. And when rules change, markets reprice. Sometimes slowly, sometimes violently. Now, let's talk about what happens after the initial volatility settles. Because markets don't remain chaotic forever. Eventually, positions normalize. Banks adapt. Balance sheets adjust. But prices often settle at new levels once artificial pressures disappear. And if synthetic supply and precious metals shrinks while industrial and investment demand remains strong, then higher price ranges become sustainable rather than temporary spikes. That doesn't mean metals go straight up forever. Markets never move in straight lines. There will be pullbacks. There will be corrections. There will be moments where prices fall sharply again. But structural shifts change long-term trajectories. And that is what many analysts believe may now be underway. It's also important to stay grounded. Financial markets are complex ecosystems. Predictions rarely unfold exactly as expected. Regulators may intervene. Exchanges may modify settlement rules. Central banks may provide liquidity. Unexpected political or economic developments could shift outcomes quickly. So this is not about predicting exact prices or timelines. It's about recognizing when risk dynamics are changing. And right now, risk dynamics are clearly shifting. Here's the key takeaway. For years, paper markets dominated price discovery in precious metals. Now, regulatory pressure is forcing greater alignment between paper claims and physical reality. And when that happens, volatility increases as markets adjust. Some participants will benefit. Others will be caught unprepared. But eventually, equilibrium returns. It always does, just at different price levels. So what should everyday investors keep in mind moving forward? First, avoid emotional decisions. Panic buying at peaks or panic selling during pullbacks rarely ends well. Second, understand the difference between paper exposure and physical ownership. Both have roles, but they behave differently during stress periods. Third, stay informed. Market narratives change quickly, and mainstream coverage often lags behind developments already underway. And finally, remember that wealth preservation is often about patience, not speed. Those who survive volatility tend to be those who manage risk rather than chase excitement. Now let's bring this full circle. It's Saturday night. Banks are still calculating exposures. Traders are preparing for Sunday's futures open. Investors are trying to understand what just happened this week. And markets are on the edge of a potentially volatile reopening. Maybe prices spike. Maybe regulators smooth things out. Maybe volatility fades quickly. Or maybe we look back on this weekend as the moment markets began repricing precious metals for a new regulatory era. We'll know soon enough. But one thing is certain. The next few trading sessions will be watched closely across the financial world. And whatever unfolds, it will offer valuable insight into how resilient or fragile the current system really is. So stay informed, stay rational, stay prepared, because markets reward those who understand change before it becomes obvious. And right now, change is clearly in motion. This is John, and we'll continue monitoring developments as they unfold. Stay sharp, and I'll see you in the next update.